You're going to get an appreciating asset. Your payments are going to go towards improving your equity position rather than going to a landlord. Also, you're going to be able to lock in that payment.
Able to afford down payment and closing costs, but it's also how much house you can afford. And in these HomeReady and Home Possible programs.
So rent, it can just go up and up and up over time versus your mortgage payment.
Additionally, they waive the LLPAs. So a standard borrower might get a higher rate because they're going to have LLPAs.
Yes, your property taxes and your homeowner insurance can increase as well as HOA dues, but the increase on those is marginal when you compare it to the rising cost of rent.
We're very competitive as we stand with 6. MI pricing engine will go out, grab the best premium, you can pick it, and we'll utilize it. We want to give these home buyers the lowest payment possible, and that is shopping essentially the MI.
Welcome everybody. We're going to give everybody about a minute or so to collect together before we start in on our content. Want to welcome everybody to today's webinar. I'm Carl Holman, the Director of Communications here at A&D Mortgage, and today we're going to talk about first-time homebuyers and affordable homeownership, but particularly some conventional mortgage options that are available. And we'll be talking with Andrew Taylor, our SVP of Wholesale Lending Sales, and Brennen Moloney. He's one of our Underwriting Team Leads. I'll get to the rules in just a minute. We'll let people trickle in for a little bit longer. So hopefully everybody is having a good day. We're all done our tax season, so we can talk about affordable housing today. Okay, we'll go ahead and get started. Again, I'm Carl Holman. We're joined today by Brennen Moloney and Andrew Taylor. Quick couple of housekeeping rules. We've disabled cameras and microphones. If you've got questions, feel free to put them into the Q&A or the chat. We do have a few that were submitted in advance, so we'll get to those at the end of the formal part of the presentation. We'd ask you guys also to turn off your cell phones just so you can focus on all the information that we're going to be presenting today. And if you've joined us a few minutes late, don't worry. We're recording the webinar and we'll send it out to you guys within the next 24 to 48 hours. So with that, let me tell you guys a little bit about A&D Mortgage. If you are a broker partner with us, you already know, hopefully, a lot about us. And if you're not, we are one of the largest non-QM lenders in the country. We've been in business for almost 20 years now. And while we do focus on non-QM, we've also been heavily involved in government and conventional as well. We're backed by a company called Imperial Fund. With them, they are able to securitize our loans on the capital markets. That gives us a lot of flexibility when it comes to developing our underwriting guidelines, particularly in the non-QM space, to help us have a little more flexibility and be able to, offer a wider array of homeownership options to people. Let's go to the next slide. We are at this point almost nationwide. There's just a few states where we're either not licensed or we're missing a full license. We do, again, mostly wholesale through brokers, but we do have a little bit of correspondent, a little bit of retail, and we do service any loans that we originate ourselves. You are able to do business purpose loans with us in about 40 different states if you're not licensed there. So we've got, again, lots of options, flexibility, and great distance between us. So let's talk about housing affordability. I mean, it's, other than the focus on interest rates currently, affordability is probably the next hot topic that I see pretty consistently written about in most newspapers, magazines, TV. I took kind of a smattering of headlines from the last few weeks. It is becoming front and center of a hot election issue. So I think it cuts at the heart of inflation. The government does seem to be making some inroads at trying to make housing more affordable for people during this time of inflation. So I'm not going to address any of the specific examples here. We'll send the presentation out, but there's links to all the articles that I was able to find in just the last couple of days. But again, it's been a hot topic for easily the last year. And with that, we'll turn it over to Andrew and Brennan. So, Brennan, let's talk about a couple of programs that are available through Fannie and Freddie that will make housing affordable for folks, whether they're first-time home buyer or not, but predominantly first time.
Yeah, thank you so much, Carl. So, within recent years, Fannie and Freddie have realized that affordability has become such a large issue, as you mentioned. So, with all of this going on, all of everything since COVID and different geopolitical events, it makes sense to try and find ways to help borrowers get into the homes. So, HomeReady and Home Possible really is primarily there to help out your low to moderate income families. They have income limitations that we'll talk about in a little bit here. But the idea is a lot of homeowners, once they get into that home, they're never going to miss a payment, right? Their home mortgage payment is probably going to be comparable to rent. They can afford it, but it's going to be a little bit of a lower down payment type of program. And a lot of people, one of the largest barriers to entry of getting into a home is coming up with that down payment. And so there's FHA, and FHA is a wonderful program, but there are borrowers who have excellent FICO, good credit scores, good income, good qualifications. And so this might be a more attractive option for those borrowers if they have, a good FICO score and the income is strong enough. Maybe it's less debt, so we can still accommodate borrowers with different credit histories, but if they have a decent enough credit history and not too much outstanding debt, they can come in with as low as 3% down. And then another element of this that's great is the private mortgage insurance payment. So we'll talk about that more later on in the presentation, but a key benefit is that mortgage insurance payment, it's going to be typically a lower monthly rate for the HomeReady and Home Possible programs. And then also for borrowers who might have limited equity, they offer mortgage refinancing options as well, which can, of course, help affordability. And especially if we see interest rates next year start to decrease, there's going to be a lot of borrowers who might have a limited equity position, but they can still benefit from refinancing, reduced mortgage insurance, reduced interest rates. And these programs will definitely help kind of ease up that financial burden for these borrowers.
All right, let's talk about the underserved borrowers that you were kind of mentioning. I guess these are people that really are struggling to get that down payment.
Yep. So typically there's a segment of borrowers who have income that is at a cap of 80% of the area median income. So there's a lookup tool through Fannie Mae where you can see what those income limitations are based upon the zip code. And so you can find out, okay, my borrower's making maybe 40,000 a year, 60,000 a year, whatever the case may be. And you can see whether or not that exceeds the area median income restrictions for that particular market. And so when you think about it, these are the borrowers that can benefit from homeownership the most because the cost of rent can rise over time in some instances. And so these borrowers, being able to get them into a mortgage with a fixed payment, as well as a payment that they'll be able to decrease over time once the interest rate environment changes, that can be a huge benefit to them. Getting these first time home buyers into their home, and they prioritize lending in certain areas that might have a lack of access to some of those traditional financing options as well. And so talking about what are the eligibility based items, as mentioned, the FICO score can access a variety of different types of borrowers. So you can actually go as low as 620 on this, which is great for the program. And then the debt to income ratio, it does vary. If you're going to do Freddie Mac's Home Possible, you're going to be restricted to 45%, Whereas HomeReady, you can go ahead and go all the way up to 50%. And then they do have restrictions in place. So if you have a borrower who's a first-time home borrower or a first-time home buyer, if everybody on the transaction is first-time home buyers, what we want to do is we want to make sure that those borrowers attend a homeownership education course. Getting a mortgage is very complicated, and your first-time home buyer has a lot to learn. So that's where you guys can step in and you can educate these consumers on all of these elements. But then, moreover, they want to make sure that if you're getting these incentives, they want to make sure your borrowers are well versed on everything that comes into place with getting a mortgage. And then another caveat about this that's important is this is not for your folks purchasing their vacation beach home down in South Florida. This is going to be more so for folks who are looking to do an owner-occupied transaction where they're going to go ahead and live there. And so moving on to some of the borrower benefits here, I'm actually going to go ahead and pass it on over to Andrew and let him take it away here.
Yeah, thanks, Brennan. As you talked about, the down payment can be as low as 3%, which is nice in that, it doesn't have to just be the borrower's money. It can be a gift. It can come from a community second or a grant. So there doesn't have to be any skin in the game, if you want to call it, or any money that comes from the borrower for that down payment. Another benefit, obviously, is the lower mortgage insurance. Typically, on a high LTV loan, the mortgage insurance coverage is 35%. With the HomeReady, Home Possible loans, it's actually lower at 25% coverage, which is a big benefit. Obviously, with the lower MI, and it does have MI, one benefit is that you can cancel it. It automatically cancels when it drops below 78% your loan to value, and that's based on the original LTV. You can request it at 80. You have to talk to your servicer. Sometimes you can get an appraisal, but before you would order an appraisal and pay for it, you'd want to talk to your servicer, because if you present it and you've gained some appreciation and you're at that 80% or even 78, then you can drop that monthly insurance, which is nice and lowers your payment. Like I talked about earlier about the down payment, I mean, there's zero contribution from the borrower. There can be. I mean, they can get gifts, grants, community seconds that they can use for down payment and closing costs. And both Fannie and Freddie on their website, they do a great job, providing all the details of these programs and where you can find them in your local area. Another thing too is cash on hand. In the old days, FHA, and I believe they still offer this cash on hand, which means that if someone, hasn't had their money fully seasoned in the bank and they can prove, and I would think, Brennan, that a budget letter or in a letter of explanation explaining how they came up with this cash and the ability to save it would be something we'd want in underwriting. But that's a nice feature as hand, a nice feature to have as well. Another thing too is family members. Back to, FHA they call them kitty condos, where you had a non-occupying co-borrower. You can have family members join in as a non-occupying co-borrower, help out, but it does lower the LTV to a maximum of 95% on that. And then again, there's no geographic restrictions, which is nice. It's all based on the median income. And again, as Brennan mentioned, there's a tool that both Fannie and Freddie offer on their websites where you can go look up by zip code or property address. And you can see what, the different income levels are. They typically have an area median income. And for both HomeReady and Home Possible, it's 80% to qualify for the HomeReady Home Possible. I know they also provide the 100%, and then high cost areas 120% of the area median income, as well as the number for 50% of the area median income, which we'll get into in a minute and what all that means. Next slide. Thanks. How can you help your clients with these programs? First, you can educate them, on the benefits and requirements of these programs. Obviously, there's income limitations on both HomeReady and Home Possible. There's also a Fannie standard 97, and there's also Freddie's equivalent, which they call Home One, where there are no income limitations. But the difference is that if you do qualify for HomeReady and Home Possible, you waive all the LLPAs, which obviously provides a lower interest rate, which is a huge benefit for people, especially with where rates are today and, obviously affordability issues. You review your client's financial situation. You want to make sure by looking up and using those tools on Fannie and Freddie's website that they're eligible, based on their income, that they meet these either area median income levels or, the 80%, the 100, or even the 50%. Obviously, I think it's a given on any loan that with lenders, you want to make sure that you have an accurate 1003 or IRLA, and that you're providing, accurate information. Other thing is, you can leverage different loan comparison tools, which we're going to look at in a minute, which compares HomeReady and Home Possible, and how they stack up against other mortgage options, how they stack up against, Fannie's standard 97, the Home One equivalent of 97, and then even FHA. And, promoting home ownership education, I think that's always been a vital issue. Most people still think that it's a 20% down payment. They don't understand, especially if they're first time home buyer, maybe what's involved in owning a home, what happens when the water heater goes out, et cetera. Just being cognizant of all the things and the process of buying a home. And then obviously staying informed. Fannie and Freddie obviously are pushing affordability. First time home buyers are making it very attractive. So you want to stay up to date. And again, you can, we'll try and keep you abreast through updates that when Fannie and Freddie change things. But again, their websites have a ton of information that can help guide you through the process.
Right. Yeah. Now, one of the things you had mentioned that is some misconceptions. And I remember last year there was a big survey that came out of potential first-time home buyers, Gen Z, millennials, and they were asking them what do they think mortgage insurance does. And I believe the number was somewhere around the range of 67 or so percent had really no clear understanding of what mortgage insurance did. I think the most common answer was it's insurance that if you miss your payment, someone else will pay it for you. It was really strange. So I think one of the things that we've been talking about, obviously, over our webinars the last few months is helping brokers advise borrowers about the basics, because it just financial, I don't want to say financial literacy, but home ownership literacy is definitely kind of a problem.
Yeah,
So,
back to the whole home buyer education.
yeah.
Insurance, mortgage insurance, the borrower pays it. Oops, previous slide. A couple of points I wanted to talk about there. Yeah, mortgage insurance is, the borrower pays for it, but to Carl's point, there's a misconception about it. The borrower pays for it, but it's insurance for the lender in case the borrowers, we don't want them to default, but if they did, and it helps the lender offer higher, loan to value loans because it takes some of the risk away from them. But, it's not to be confused with credit life insurance, which is another misconception that, mortgage insurance, not only missing a payment, but sometimes if someone were unfortunately to pass away, that it would pay off the mortgage. That's mortgage credit life insurance. So, just another clarification. By having mortgage insurance, like we said, I'm still another misconception I'm amazed at is even my own son did this, told me this, that he thought you had to put 20% down, and I'm in the business. And I was kind of shocked. But, back to home ownership literacy, this mortgage insurance allows lenders, again, to offer higher, loan to value products so that there's, people can afford homes and put less down. And then obviously, the big key is, you're going to pay for it for a while, but, at 78%, it drops off automatically. Your servicer will drop the MI and lower your payment without having to refinance. And that's a big key. And I think I saw that a statistic that within 5 to 7 years, with the way appreciation's gone, home appreciation, that it could be sooner. But again, it's based off your original loan to value. But if you were to pay for an appraisal, if your house had appreciated dramatically, you could talk to your servicer about doing that and presenting that appraisal to them and getting the MI removed sooner.
Okay.
Okay,
Well,
next
then let's take a quick look at. I mean, you've talked a little bit about FHA, but let's take a look at the differences between the HomeReady, Home Possible, and some other financing options.
Yeah, I mean, right now, Home Possible, HomeReady, 3% down, FHA's 3.5%. And that's typically lower, than most people think. On a loan, like we talked about the misconception. Again, HomeReady and Home Possible, you don't have to, there's zero borrower contribution if they use a gift, a grant, a community second, and it provides, great flexibility for them. Reduced PMI premiums. Typically on a high LTV, I already talked about, you pay 35% coverage. On the HomeReady, Home Possible programs, it is lowered to 25% coverage, so it's lower immediately. Good thing too is it's not, HomeReady and Home Possible are not just for, first-time home buyers. You don't have to be a first-time home buyer. You can previously own a home. If you have a home and you want to buy another home, you can still do a HomeReady, Home Possible. Another great feature that Fannie and Freddie just came out with recently is this $2,500 credit for what they consider very low income borrowers, which again, if you go to the tools on Fannie and Freddie's sites and put in the zip code or the property address, it'll give you the area median income, and HomeReady, Home Possible is 80%, but at a 50%, if you meet the 50% area median income criteria, you're eligible for a $2,500 credit for closing costs and or down payment. So that's a nice feature. FHA, we've talked about this a couple of times, maybe not specifically in terms of their mortgage insurance, but you have an upfront mortgage insurance premium, which can be pretty high. And we'll look at it on one of the next slides. But if you put down less than 10%, which most people do on an FHA loan, you're going to pay the MIP or monthly mortgage insurance premium for the life of the loan, and you can't get rid of it. Versus what we talked about, with being able to eventually cancel PMI on a HomeReady, Home Possible loan. And then same thing with VA. Even though there's no down payment, there is, guarantee fees and whatnot. And so, I'm not sure that you can get rid of the VA MI or monthly MI as well. So
I don't think so.
Next slide.
Right. Yeah, so let's look at that, how that calculates out.
Yeah, just a little comparison here. So, FHA, with the 3.5% down, you'd have a base loan amount of $241,250. This is a purchase price of $250. HomeReady and Fannie Mae Standard 97, which I mentioned, is 3% down. So your loan amount would be $242,500 in both scenarios. Like we talked about, FHA is an upfront MIP that's typically financed into the loan amount of 1.75%. HomeReady and the Fannie Mae Standard 97, there is no upfront MI. So the upfront MI under the FHA column is the 1.75% that's added to the base loan amount. So if you took a look at the total loan amounts, the FHA with the financed MI is $245,472 versus HomeReady and Fannie Mae Standard are $242,500, which is just your straight 3% down. So obviously, that affects your down payment a little bit. which is better for the HomeReady and Standard 97. And then your monthly MI rates. If you look, at the FHA, it's at 0.85%. Remember, it's reduced on HomeReady if down to the 25% coverage. So the premium for that's 0.77, which is less than FHA. But the standard 97 is the standard conventional coverage, and it's high, for a 3% down program. Then you can do the math based on those monthly MI rates. Your monthly MI on FHA is 171, on the HomeReady 156, and on the Fannie Mae standard it'd be 194. So you've got the P&I calculations. Your total monthly payments on FHA of 1,656. HomeReady, very, very comparable, 1,689. And on the Fannie Mae standard, a little bit higher because of the higher premium, 1,767. But the big difference is the monthly MI premium. And like I mentioned, after about 5 years with an annual home appreciation of 3%, which is not unrealistic these days, you can waive it, which lowers your payment without refinancing. So as you can see, ultimately your payment on the Fannie HomeReady program and the Fannie Mae standard, even though it's some higher MI initially, with that home appreciation and able to automatically cancel your MI, it lowers your payment without having to refinance and go through the added costs.
Cool. All right, Brandon, let's take a look at some real world examples of ones that we've done.
Yep, absolutely. And kind of what I'll do with this example, we're talking about, your young couple, Adam and Jenna, they recently got married. Now they're looking to move on to the next step, buy their first house. We'll pretend, we had that matrix on the last slide. I was taking some notes during that. And we'll say they're torn between, hey, do we want to go FHA or do we want to go HomeReady through conventional? And so, at the moment they're both employed, they have decent enough jobs, but again, it's kind of a tight job market and we're in a unique moment in time where affordability is pretty difficult. So, they can pay their bills, but they have limited capacity to save just due to the fact that there's that pressure from the rising rents and they want to get better jobs. They've put 30 different applications out throughout the last year, but it's hard to really lock down something that gives them a stronger income. So because of that, they're pretty low debt and they make below 50% of the area median income. And what that makes them eligible for both HomeReady and Home Possible, they have that 2,500 credit because they're a little bit lower than 50% of the median income for the market. So they can still get approved for the mortgage. They're trying to purchase a very reasonably priced, condo or single family residence. And because of how much they're squeezed with the job market and with the cost of rent, they have a difficult time saving up for that down payment. So all these different credits, these community seconds, the lower LTV, that helps a lot. And one thing between FHA and conventional that is super, super beneficial is that FHA, you have to pay that UFMIP, the upfront mortgage insurance premium. So in the previous example, a 240 some $1,000 house, that's $4,200 for the borrowers. So that is, for these types of borrowers, $4,200 is a lot of money. And then when you combine that with the reduced mortgage insurance costs, it was $123 a month of savings. And so everybody has different financial situations, but for a young couple who's looking to, build equity, make ends meet, they're making 50% of the area median income. $123 is huge. Like back when I used to do sales and sell refinances as a loan officer, I would be able to get deals closed because we were saving someone $123 a month. So you never know someone's situation. And so the more knowledgeable we are as sales representatives, the more accurately we get borrowers into the right programs. the more benefit that we're going to provide to them. And especially since a lot of these people, in this example, it's a younger couple, if you educate them and you really walk them through this process, they're going to love you, right? They're going to give you referrals. They're going to be confident that you took care of them, and you're going to probably be their LO for life. You know, you're going to get a lot of loyalty if you help them out, because now they're able to get out of the cycle where all their paycheck is going to their landlord. Now they're building equity in something that they own. They're beginning the process of generational wealth. There's a narrative going around that, you know, it's impossible to buy a house. It can't be done. You're the one who made the magic happen, and you're helping keep their payment relatively fixed. And again, through HomeReady, you can get them all the way up to 50% debt to income ratio in order to make this happen for them. So love this program. And, you know, whenever we're working deals here on the underwriting side, we always try so hard to get creative and find ways to make these work, just because we understand how much of an impact that it has on people's lives.
Good. Yeah, generational wealth is definitely important for those first-time home buyers, especially if they're just starting families out. Let's turn to some questions that got submitted in advance of the webinar and see where we go with this. So we had a question from Sheldon Perry: what affordable housing programs are available in Texas? Andrew, if I remember, you're based in Texas. What can you tell us?
Yeah. Really, ultimately, there's several programs. You know, there's affordable seconds, which Fannie offers, as well as, you know, there's county programs, there's city programs, there's state programs. But, you know, in terms of which one would be best for your customer, again, Fannie Mae's website lists all these programs, which ones are eligible. And they do a great job, you know, based on where you live or your zip code. They can tell you all the different options in the area. So there's a lot of them, and a lot of people don't take advantage of them because people don't know about them. And that's part of, you know, educating your customer. If you can become an expert in these programs, I mean, especially, you know, first time home buyers, or not even first time, just people that, you know, are having affordability issues, you know, as Brennen, you know, issued, or I think Carl, you did, about the whole down payment issue. You know, in these HomeReady, Home Possible programs, it can all be a gift. It can be a grant, a second, et cetera. So, you know, affordability means what? You know, being able to afford down payment and closing costs, but it's also how much house you can afford. And in these HomeReady and Home Possible programs, additionally, they waive the LLPA. So, you know, a standard borrower might get a higher rate because they're going to have LLPAs based on credit score, LTV, et cetera, but they're all waived under the HomeReady, Home Possible program. So right away, they get a lower rate.
We got a question from Lewis about what types of DPA programs do we, A&D, as a lender, have available to them?
I'll take that.
Either of you.
Whoever. I mean, we don't currently offer our own DPA programs, but again, you know, back to what I said earlier, there you can go and look at on Fannie and Freddie's website, depending on where you live and where your borrower lives, and you can find all the available programs. They do a great job telling you who all's involved and who will offer these down payment assistance programs.
Okay. Brandon, I think this one's definitely for you because we kind of were just talking about this, but what's the advantage of being a first-time home buyer versus a lifelong renter?
Yeah, so that depends on quite a few things, right? Because home buying is not right for everyone at this specific moment in time. And then also, there's a lot of people where renting really does make sense. But as mentioned previously, you're going to get an appreciating asset. Your payments are going to go towards improving your equity position rather than going to a landlord. And also, you're going to be able to lock in that payment. So rent, it can just go up and up and up over time versus your mortgage payment. Yes, your property taxes and your homeowner insurance can increase, as well as HOA dues, but the increase on those is marginal when you compare it to the rising cost of rent. Now, with that said, you want to make sure that your borrowers really understand their position. If they are frequently job hopping, if, maybe I'm going to get a job offer in Texas, maybe I'll move to Florida, right? They got to have, typically it's better for folks who maybe have pretty deep roots, who have been in the area for a while. They're confident that they want to stay because homeownership can be a bit of a money pit if you were to buy a house and then decide that you want to move or sell it pretty recently or pretty shortly, or if you're expecting family and you buy a small little ranch and then you start having family very shortly thereafter, you might outgrow the size of your house and you're losing a lot of money in closing costs and fees. And so by having a good relationship with your borrower and really understanding not only where they're at this specific moment in time, as well as their financial position, if they can afford the house, if they're going to have enough reserves for when that hot water heater goes out, things of that nature. Understanding where they're at right now, but then what their goals are, what they want to do, where they want to go, you can really help point them in the right direction and provide additional value to them.
Okay, great. Next question is, it's conventional related, but not specific for HomeReady or Home Possible. Somebody was asking about when will our conventional MIs be more competitive for low down payment options? I'm not sure which of you wants to tackle that question.
Yeah, I'll take it. I mean, we do business with all the MI companies and, all 6 of them. And, they've gotten very specific. They've, top secret algorithms, and they run everything through a black box now. That's how they all price. So depending on, the features of the loan, plus we have a pricing and MI pricing engine in our new portal, which we just released on Monday. It'll go out and find the best premium for you. So we're very competitive as we stand with 6. The MI pricing engine will go out, grab the best premium, you can pick it, and we'll utilize it. We want to give these, home buyers the lowest payment possible, and that is, shopping essentially the MI and providing the lowest premium for them.
Great. Well, that's all the questions that were submitted in advance. I haven't seen anybody pop one over yet, but let's give folks a minute or so to throw in any last minute questions. We can go to the next slide until we get there. Yeah, so I'll just do a quick reminder for folks, just to kind of wrap us up before we get to any last minute questions. As you've kind of been listening to Andrew and Brennen, one message that's clear about A&D Mortgage is that we're here as your partner to help grow your business. I already talked a little bit earlier about our flexible underwriting and our loan solutions. That's, again, because of our relationship with our securitizer. We also have an extensive secondary marketing and research department that's always monitoring the markets to help us adapt our loan programs to be competitive, including rates as well as underwriting guidelines. And as you've heard both Andrew and Brennen, we've got very much a can-do attitude. I mean, we really want to promote home ownership for people. And the way we do that, in addition to being competitive, is to have a really streamlined loan process and try to make it as easy as possible on the brokers, the borrowers, so that we can get everybody to the closing table as fast as humanly possible, especially in today's market. I mean, we've been able to close different loans in under 10 days. So we got a pretty well-oiled machine. And one of those new parts of the machine that Andrew just mentioned is our new enhanced partner portal called AIM, Artificial Intelligence and Mortgage. We did launch it on Monday. We would encourage folks, if you haven't tried it out yet, go start putting a 1003 in, get a loan going, and then you'll see it's extremely easy to use. It's almost foolproof at this point. And then we'll help get you closed fairly quickly. Let's go on. We just got a question in, so let me Yes, sorry. I answered this question at the very beginning. It's the one that it's almost always the first question. Yes, you'll be getting a copy of the recording of this video as well as the presentation itself. We typically do it within 24 to 48 hours, and it will be up on our YouTube channel and AD Learning Center on our website. So you'll have lots of opportunities to see Andrew and Brennan again at your earliest conveniences. Speaking of which, I did mention our broker portal. We're going to be talking a little bit more about our technology platforms next Thursday with Irene Wright from our broker support team and Nadezhda Smokvin from our business development team. So we hope you guys will have a chance to go out to our website or test out either our quick pricer or our enhanced broker portal, and just anything else that you find on our website. We'll be here live to answer questions on what we've put together. Then for new brokers, and even if you're an existing partner and kind of want a little refresher, we do a monthly broker orientation during the first week of the month. So we'll be doing one on May 7th. And then I believe it either be Andrew or one of his members of his team will be joining us in May. We're going to be doing another government program. So we'll be looking at the FHA loans and options that are available for home buyers as well. Okay, and that is the end of our questions. So if you are not currently a partner, I'd encourage you guys to scan the QR code and start filling out a broker package and find out how fun and easy we are to work with. You get to talk to people like Brennan and Andrew every day, especially if you're doing conventional loans. And with that, I'm Carl Holman. I will close this out. I hope you guys have a great rest of your week, great rest of the month, and hopefully see you back in here next Thursday to talk some more about our technologies. All right, gentlemen, thank you. Have a great day.
Thanks, Carl. Thanks for
Thank you,
attending.
guys. Yep, see you guys.